back to the Capital Mindset Show, guys. We're your hosts, Austin and Fabio, and today we have an episode sort of on Alibaba, as well as our fears of investing into the Chinese markets ourselves. We've made several videos on this on the past, and today I'm going to be kind of exploring this sort of from a beginner perspective with Fabio, and he's going to be kind of breaking down what a VIE is, some of the capital restrictions, some of the precedents that currently exist in Chinese law for such actions, et cetera, so forth. And then also, I do want to say before we start this video, if you're an investor in Alibaba, let's say, do know that you will likely have the preconceived notion coming into this that we are wrong. And just basically, for all intents and purposes, we're just asking you just to keep an open mind with the things that we're saying, just to, question what you're being told, question basically everything when it comes to Alibaba. So without further ado, let's jump right into this. What are we looking at here today?
Yeah, and I'll actually add on to that last point you made, because everyone's kind of aware of, or maybe not everyone, but the Overton window. And we're going to do our best to speak within everyone's Overton window and with regards to Alibaba. But I do understand that if I say something that is outside the Overton window, the message won't get across because your brain will shut off if you completely disagree. And it's natural. It's something that we are still, studying in psychology today. But just be aware of that. And if you're self-aware of it, you can kind of prevent it, which is why I always try to do when I'm listening to arguments that I may or may not be aware of my preconceived notions against them. But I also want to highlight, we've done a video on this. It's our second video on the matter. And it goes into a lot of the legal precedent that we covered. So a lot of it is a culmination of a lot of research done, and a lot of research done actually at my work, that we actually consulted a lot of subject matter experts in this matter. And so it's a culmination of all of that. And then from that, we drew or understood conclusions about the nature of these investments. And I'll be explaining that, and Austin will try to keep me, restrained, because it is.
I'll try to rein in his mind.
It is a very large, very large topic, and it's going to be a challenge to bring this very complicated, very large topic into a easy to understand and compact video. So without further ado, I will begin with an analogy to try to set the stage. So Austin, you're going to be an investor, and I'm the owner of company A. Okay. So you're going to invest in this company, and I'm going to give you something no one has in the real world. You're going to have information that is both completely accurate and highly pertinent. Okay. What is this information? Well, I'm going to tell you the growth rates ahead of time, and they're actually accurate. Okay. So let's say the growth rates are 50% compounded for 20 years. Fantastic. Okay. Fantastic growth rates. And those are guaranteed growth rates, something that doesn't exist in the real world. And you have this before it happens. Okay. And the business right now is valued around $1 million. Okay. And it generates about $100,000 a year in income. And remember, it's going to grow by 50%. Okay. So what you have is 100K, and I'm asking of you 100K. I'm trying to raise $100,000 in capital. So think about the proposition I've laid out before you. The company is generating $100,000. The company's market value is $1 million for whatever reason, and you identify that as undervalued. You somehow know it will grow 50% a year for 20 years. On paper, it appears as though this investment is a steal. Okay. And so you engage with me and you say, I would like to purchase $100,000 of stock. And I say, for sure. However, I'm not going to give you stock. Instead, I'm going to give you an agreement with an agreement with an agreement with an agreement with me, and I own the stock, that I will supposedly owe you some money. And then what are some questions you have right off the bat? Do you have any questions about the structure?
My first question would be, why can't I own it outright? Secondly, would also be, let's say, if I can't own this outright, is there something legally binding actually enforcing this contract? Is there a legal force actually enforcing this contract? And then third, I would also ask, why does it have to be a contract inside of a contract inside of a contract inside of a contract? Why can't I just, even if I can't own the business, why can't I just sign a contract that says that I'm entitled to this amount? Basically, owning the business.
So very good questions. To try to simplify the answer. For the reasons as to why, well, it's because it's illegal for you to own part of my business. And for the contract stuff, it's to make it simpler, the jurisdictional protections for me, so that you have to go through many jurisdictions. I don't want you to go directly to me. And it's to maintain myself within what is called in legal speak, the faith, right? The faith and intent of the law. Okay. And that's very important for later on. I'll explain that, what that means. Remind me that I said that, because actually it's quite important for this topic. So with regards to the business at hand, yes, you just own that. You don't have any voting rights. You don't really control that, as far as I allow you. And you don't have any, you have presumed economic rights, but no real economic rights. And you are going to be governed under contractual law and not property law, which is weaker. And you're going to be governed under multiple jurisdictions, not just one jurisdiction. So you can't go to the US courts to fight me. We'll have to fight in the Russian courts. How about that?
Okay. Because
so let's use Russia, not China, as an example.
So then my first question would be, why would it be illegal for me to outright own your business?
Oh, it's just the way the law says it.
So the law is saying in China, because we're talking about China now, outside of our
so
example.
let's switch to China. Yep, the real one. Yeah, let's switch to the real life example.
The law is saying that as a foreign investor, I can't invest into Chinese enterprises. Therefore, I have to go through this means of owning contracts to then invest in these Chinese enterprises. Well,
okay. So
if that's the case, then my question now is, why am I burdened behind so many contracts? Why can't I just have one specific contract?
Well, I
mean, that's not really a very good question. What I'm trying to say is, why there's so many steps I have to take to achieve ownership in this. Why is it such a complex process that they've kind of designed?
There isn't a complicated process for you. You're buying just this piece of paper. You're not buying each piece of paper along the line. No, it's super simple for you. You're just buying that. Now, what I get as a benefit is I get all these added protections. So if I, mess around with our little agreement, you're gonna have a problem there. But let's not assume I do. Let's actually not assume that I do. Okay. Let's get to the core question, because sometimes investors, they forget the basics. And the basics of investing, simply being, and you might say, wow, that's extremely basic, is what drives value. What actually is behind the fundamental value of an investment. And Buffett has said this for so many years, and it seems like it's, for a lot of people, it still doesn't click. It's, why does he say that you need to buy a business and be okay with it closing, the stock market closing for many years? Because think of it like a private company. And he actually says that you have to think of it like you're the full owner of a business. For a lot of people, it's very difficult to imagine that, because they've never owned a business. But if you've owned a business, you can kind of relate to this and say, okay, if I owned a business, what drives the value? Well, the value driven is simply the return on capital, right? The return that I make, the company generates income. And then after all my expenses, I'm left with something. And from there, I can draw cash and then go pay for my expenses. And then I can continue this going forward, and it can grow, etc. But I don't care about the daily value of the business, because I'm not looking to sell it. Now, stocks have the liquidity value, right? And so you can sell your stock at any given point. And that's the added benefit of owning stocks. It's liquid. But Buffett has attempted many times over the years to try to get investors to think about stocks as the same as private businesses. And that's what he's trying to say. Well, he is saying it successfully, but for some people, it's not clicking for them. And so when we talk about this business, this hypothetical business again, the value, right, is in the eventual capital returns. So let's add another point to this. What if I told you, Austin, you're going to invest in this business and I will never give you money? Doesn't matter how much money this company makes. I will never give you money.
Why would I invest into this business then? I'd just be giving you money for free. I'd basically donate.
Precisely. Precisely. And I
Yeah.
love that. I love that you'd give me money for free. I'd love that. But
Yeah.
let's say it's not even contingent on you owning it. Let's say you try to sell it to the next guy. Let's say you have a cousin. Your cousin is looking for an investment. He has a lot of cash, and you're going to try to convince your cousin to buy the shares off of you. And then your cousin finds out that I will never give your shares the economic return, like economic return in the sense of capital return, right? Would your cousin buy them off of you? How would you convince? What argument would you use to convince your cousin to buy those shares off of you?
The only argument I would have is
The share price will go up.
yeah, literally. Yeah.
Greater fool theory. Greater fool theory kicks in. So why am I saying that example? Well, because even in an American stock, some people might say, well, some stocks don't give you capital returns for a long time. Precisely, the key word for a long time. If I could guarantee you a stock would never give you capital returns in the form of dividends or buybacks, the stock has no value. It would simply be a piece of paper that you could sell to another person. The problem is you do not know that, right? So you're always buying the potential, and the potential has value. But if you somehow got the guarantee, be very careful with my words there. You somehow got the guarantee that the company would never provide capital returns. The stock is worthless. It is literally a piece of paper. But even if the company currently is not giving you a capital return, there's always the potential because you do not have the guarantee. Therefore, that in and of itself is the value. And the capital returns are derived from the fundamentals. That is the only reason why the fundamentals matter, because the fundamentals are the core, the pot in which the capital returns are drawn from. And then the capital returns, the potential for them can grow as the company grows, and ergo the value grows. And depending on that growth rate of those fundamentals, the price at which someone's willing to pay will go up or maybe go down, depending on the growth.
So kind of shifting this back to Alibaba now, how
Yes.
does everything that we've just described relate exclusively to Alibaba, as well as our reservations in investing in Alibaba or as China as a whole, Fabio?
So Chinese companies are VIEs, right? They're not, you're basically comparing apples and bananas. And for those of you who get the innuendo of Chinese companies being bananas, good on you. And I fear for your mind. But if you kind of come to from the premise that you're comparing apples and bananas, you're going to understand what I'm saying here. So for those of you who don't, I'll try to break that down. Why does it connect, right? And it connects because the net, this is a new vocab term, the net capital return will be negative. Right. Now, what does that mean? Well, what is capital return? Again, capital return is dividends or buybacks. And typically you would want that to be positive. Michael Burry spoke about this in his letters. Yep.
Yes. No. Go. Continue about Michael Burry.
Well, Michael Burry, and it's not a
interested.
video about Michael Burry, but very briefly, Michael Burry in the years around 2000, he spoke about this in his letters, saying that you got to be careful with buybacks and how management can do things to trick you. But what basically, in summary, what he said, he didn't use the word, but net negative capital returns. So net negative capital returns is what we want to be fearful of. And Chinese companies are very guilty of this. So they may announce buybacks, but the buybacks are minuscule in terms of comparing to the share dilution that they've done. Because if I am basically offering you a piece of paper in exchange for money, into which I can then grow the business, I will do this every day, all day, for as long as possible. And I want to segue briefly into the straw man argument that is, or at least it's some argument that some people use. I completely disagree with it. Some bears for Chinese stocks say that the delisting is a risk. I do not think that at all. I think it's very silly to assume that. And for those of you who, again, may have preconceived notions that we're wrong, may think that that's what we're saying. And I've seen that our arguments misrepresented before, that is what we're saying. That is not what we're saying. In fact, we're saying quite the opposite. We're saying because of the structure, that is the last thing they'll do. The last thing they'll do is delist these investment vehicles because they're giving you nothing in exchange for something. And so why would they delist it? There'd be no reason to delist these companies. So now segueing away from that, back to the main topic, the net negative capital returns is what I assume to be from China. And I would say two things about the popular investors that are in this company. Monish Pabrai, I don't know if everyone's probably seen this by now, but if you know about Monish Pabrai, you've probably seen that he's removed a significant number of his position. And I've discussed this in previous videos as to why you should not follow large investors into investments. Cloning can be very dangerous if you do not have access to information. Information is very crucial, and the timing of the information is even more crucial because things can change.
Yeah.
And so if you are investing simply because this individual is investing, your argument is founded on sand.
Yeah. Well, I mean, this also brings up another point too, because if I'm extrapolating from the greater idea of what you're saying, is that really when you invest, you should really come to your own opinions, your own conclusions about things, and then act on what you believe to be true.
Correct.
Because, and that's really I feel, in my opinion, that's really the greatest challenge for a lot of people, is a lot of people like to be shown the way in almost a sense. But with investing, you have to forge your own way.
Exactly. So what we've discussed before in private,
Yeah.
You have to forge your own way in this world and in the investing world. And everyone will have
actually, I would actually say that you have to forge your own way in the world, period, as well. That's really how,
getting philosophical.
Honestly, that's what makes life worth living to me, to be honest. But that's neither here nor there. That's a completely separate video. We can make a philosophy video sometime if the audience wants it, we will. So
yeah, maybe. But the other thing is Charlie Munger. Charlie Munger fits this in two ways. One is, to counter, and one is to the pro. So how I would actually utilize Charlie Munger's wisdom is show me the incentives and I'll show you the outcome. If I am incentivized to sell you pieces of paper and give you a net negative capital return, then I'm gonna very well do it.
Yeah. And so why would you stop?
Yeah, why would I stop?
Yeah.
So why would I delist? What interest of me would it be to delist? You already have no control of the businesses. You have no ownership of the business. Why would I stop? What am I losing?
Yeah.
So now here's the I'll go back to Charlie Munger because but here's the thing. You got to be aware that Xi Jinping may have different political philosophies than his predecessor. So his predecessors highly liked the VIE structure. Xi Jinping may not like it that much, or may not think it's necessary, or may not care. So if he changes his mind and wants to continue to prop up the VIEs, you might well see some actions, because remember, they have to continue the facade for as long as possible so they can raise as much capital as possible as China rises to become the most powerful country on earth. And then when it does, it can implement, its own little world rules. But for now, it has to continue the facade that the Western class is essentially giving it capital for which it can fuel its growth and investment without giving up anything. And if it can continue this facade until it finally reaches the point in which it itself is the world leader, then, I mean, it could. If I were it, I would continue it for as long as possible. If the United States could do that to the Europeans, I mean, I imagine like we would totally do it. Any country would do it. Yeah, if I'm being honest, like if we could sell stock to the Europeans and then not give them any ownership in our companies, but they were perfectly willing and drawn by the allure of American growth, etc., I imagine the United States would do it. But the thing is, like, we're bound by market forces, and ergo,
and also, like you had talked about
don't
at
have
the
the same
beginning
facade
of the video, the faith and intent of the law. That's what we're also bound by as well. So now let's kind of explore that. Let's sort of explore, again, this precedence that exists inside of Chinese law for basically not honoring even ownership claims to these specific entities itself from foreign investors. And let's also explore a little bit of Yahoo. We've made other videos on this in the past, but
I was going to say,
I personally believe it's pertinent to at least revisit it a tiny bit. That way it kind of colors a little bit of what we're talking about here some more.
I went over specific court cases within China, specific informative pieces about Chinese law. I did go over capital restrictions in China, which are very pertinent. And if that clicks, things start to make more sense. Because if everything's clicking together, it should make sense. Basically, you do own nothing. And that segues into Yahoo and SoftBank. So if you think this is a small fish problem, just wait till you see about the big fish. Well, Yahoo and SoftBank were two very large fish, right? And they owned a significant portion of Alibaba. Now, Reuters has a good article about this. I forget what year it was. I think it was 2012, 2013,
2011.
2014.
Yeah,
2011. Okay.
Yeah.
So the journalist major, I know I smack down on journalist majors a lot. I don't hate journalist majors, but I say that a lot in the videos. But the journalist major,
It's an ongoing joke.
yeah, and it's an ongoing joke. It's not derogatory. The journalist major who wrote the article did a fantastic job in reporting it, by the way. But when I say journalist major, I'm explaining that they lacked industry knowledge or industry understanding of law and finance to kind of grasp the problem at hand. And could have been simplified by them actually interviewing a lawyer or something like that. But they expressed surprise as to how Yahoo and SoftBank had very little control over Alibaba. In what context was that said? Well, Alibaba took away Ant Financial away from Alibaba. That was part of Alibaba. And if you forget, then you see it kind of shows how people have short memories, or maybe you weren't around or investing at the time. But you need to remember this. That set precedent. Okay, you have to remember that. That set precedent. And they were eventually compensated, but pennies on the dollar. So Austin, you're an investor in Amazon, and Jeff Bezos says one day, oh yeah, Amazon Web Services is separate now, and you get nothing. Would you be angry?
Yes, there'd be lawsuits like crazy.
There'd be
I'd dump the
lawsuits
stock.
Yep.
The market would dump the stock.
Oh,
Amazon
yes.
would basically become uninvestable at that point.
Yes, it would become uninvestable. It would become uninvestable if they did something like that. Alibaba didn't become uninvestable. In fact, Alibaba is, talked about a lot, and people think it's a great company. I mean, it is a great company, but what you own is not it. So, but I was going to say the journalist major expressed great surprise as to how Ant Financial was spun off, and Yahoo and SoftBank pretty much couldn't do anything about it because they didn't control anything. Because the journalist major was looking at the two and comparing an apple to a banana and saying that the apple is the banana, right? And again, if you get the innuendo, but the apple, the apple is an apple, and everywhere else in the world they're apples, they're stock markets, and the Chinese stock market is a banana and does not behave like an apple. Okay, and its use cases are very different. So the confusion was only warranted if the journalist major or the individual observing this did not understand that context. And once understanding that context, it makes complete sense. Of course, you don't control anything because you don't own anything. Ownership, control, ownership.
Yeah. Well, something else I kind of want to bring up now, like even sort of diverging from China as well, kind of going into Russia. Because you said earlier that this business would be based in Russia. And I kind of feel like there's a sentiment that a lot of people are almost...
To clarify to everyone, the original example of the made up company, I said, let's not base it in China. Let's base it in this. And Austin's pointing out the reason why I chose Russia.
Yeah. So now the thing about it is that now I'm kind of curious. There seems to be almost like a fear of investing into Russian markets. And I kind of want to explore now, is that fear even warranted? And then also... No. And then also, no. Yeah. Because you've made investments in Russia before. My other question to you is exactly that. Are we only looking at a specific use case where one specific sovereign nation is legitimately a banana and the rest of the stock markets are apples? Is that basically what we're looking at?
Highlight here again the innuendo of the banana.
Yes.
But
that's why I'm laughing.
Because we want to make the show a little more entertaining. But
well, I mean, venture's the best part of capital mindset. Come on,
yes, I'd say yes. And I mean, like, Russia is sometimes viewed as uninvestable by a lot of Americans for reasons I don't grasp, except for those who just don't pay attention too much, but that's understandable.
Yeah, it is.
But for those who kind of understand the nuances, like, I do think Russia's riskier, right? I'm not crazy. Russia is riskier than other markets, but it's not something that can't be discounted. I made a tremendous amount of money in Russia before. I think Sven Carlin also has made a lot of money in Russia too. He would agree with me on this. But the problem is I don't understand why you think China's not as risky. I think it's like tremendously more risky. I think the level of Like in Russia, when you buy a Russian stock, you own the stock, you own the company, like you have rights.
Yeah.
When you buy a Chinese, well, you're not even buying a Chinese company. That's the thing. That's what we're all discussing. And then again, going back to those basics, the value is derived from the eventual capital returns you're going to make. And if they're giving you a net negative capital returns, then the laws of finance would say, or the basic laws, the fundamental ones would say the investment that you're looking at is worthless. But when you plug a China symbol next to it, then people ignore it. People forget the rules, forget the laws, the basics. You just ignore it. They're like, oh, China next to it, big growth, buy. And I think, is there anything in what I've said so far that you think the audience might need a little bit of clarity? Because it's sometimes difficult to understand where I've missed. And that's why I'll say here, if there's a point where you have questions, if it's not too complicated question, I'll try to answer it. Comment down below and I'll get back to it, because I understand that this is a hefty topic. I will reference, if it's anything basic with Chinese law, go to the second video on this. We'll probably put a link in the description.
Yeah, definitely.
That video I do explain, and I cite some court cases. For some reason, the court cases are very difficult to find in Google. Not conspiratorial, they're very difficult to find. You can find them, but it's weird. I mean, I don't know if it's because it's Chinese law. No, I know, because it's information you gotta like, yeah, really dig for, maybe even pay for, which sucks. But it is there. I mean, you can just listen to the references and then try or attempt to find them yourself. There were no links that we could find, again, to provide in a free source. So that's what I'll say about that. But you can watch that video, and then that maybe answer some of your questions. But if it doesn't, comment down below and I'll try to do my best. But I think we should go into the model. If there's nothing else I need to clarify, I think I covered everything. Remember that if you own Alibaba, you're probably like, we trying to speak within the Overton window, because we know if we speak outside your Overton window, you're going to just shut us out. But just hear the arguments out, because here's probably what you're thinking. And I want Austin to tell me if I'm good to go.
The screen is not yet.
No. I'm good to go with, like, and if I,
yeah, no, I was going to say you described everything pretty much as well as we can, given how complicated this topic is.
Yeah, and remember, the argument is not delisting. They're going to keep doing it for as long as possible. In fact, I expect them to do some things to favor the perception of the VIE at some point, maybe hopefully make the stock price go up. Remember, stock price go up is just greater fool theory. You're not actually investing in the fundamentals, because you can't, because they're not connected. So I'm going to take us just then to the model. What did I even show? I haven't even shown the, let's actually go over this first. But the stock price went down today. And before you say, that doesn't validate my argument at all. My argument's not validated by the stock price move. This stock price move perhaps is not even correlated with the fundamentals. It's just some haziness of the market. Remember, the market just goes down when there's greater selling pressure than buying pressure. That's mechanically how it does. It's not necessarily always connected to fundamentals. But basically, from the arguments I've presented here today, the initial or the actual intrinsic value of a VIE or a Chinese VIE is inherently nothing, because we've discussed other VIEs and like Rocket Mortgage, how Rocket's an American VIE, but Rocket has an intrinsic value because there is economic interest, and you will actually see some benefit, economic benefit. Now, it depends on the price you pay, and it may look more expensive, and that's a whole other thing. We discussed that in that video, how the American VIE is already complicated. The Chinese VIE is this on steroids. So I would express that this drop doesn't really have to do with my argument. My argument, if the market were to realize it to fruition, it would be a lot lower, to say the least. Because everyone would realize you don't own anything. So people don't actually realize that. It's like people know it, but they don't know it. You know what I mean? How it's like there's complicated topics in like mathematics, like you know it, but you don't know it. You don't know its origins. You don't know how it came. People came up with it or stuff like that. But
yeah.
Let's go into the model. And this is kind of like where I was talking about how people invested in the stock probably think of it like this. They're looking at this company, and I know it's growing at like 22, like 22%. They're like, oh, it's buy. And the model's telling me, yes, buy. Please buy this stock as much as you can. And it based on the book fundamentals, it is a buy, but based on the more nuanced fundamentals you need that sometimes investing requires, oh, most definitely not for me. Okay. Now everything I've set up until this point is only correct in the current circumstances of which Chinese law operates. So for example, if the government were to institute major changes in the future and exchange everyone who holds a VIE with shares of the company and actually give you ownership and economic rights and all the et cetera, and they did a 1-to-1, I have no idea why they would do that, but I'm assuming they will. Then my assumptions change, and this is a best investment, not best investment, but a very good investment someone can make right now. But how many assumptions did I make in that statement, Austin?
You made a boatload of assumptions in that statement. And another thing I also want to ask too, I've seen some other creators say, oh, well, I don't understand why they're continuing to dilute the shareholder base, more like contract holder base, if you ask me. But I don't understand why they're continuing to dilute the contract holder base here. Would you kind of explore that a little bit as well, maybe for some of our newer audience who might be a beginner to these sorts of things, why, sort of helping them connect the dots as to why they would continue to dilute the contract holder base in this instance?
Well, because the cost of capital is basically zero. If in the traditional sense, if you compare the apple to the banana and say they are the same, then no, there is a cost. But once you understand that you're comparing an apple to a banana, there is no cost. Of course, they're going to dilute the shareholder. I keep calling them shareholder base. They're the contract holder base. Of course, they're going to dilute them because they're not giving up anything. And the point of cost of equity is implicit in the economic interest you are giving up going forward. So if you're not giving up true economic interest, you are not giving up anything. Therefore, the cost is zero. So the cost of equity is zero. However, they have to manage it because they got to keep the facade going for as long as possible. The facade being, I got to make sure you, Austin, let's say you are either investor in this example, I got to make sure you don't panic or you don't realize that you're not owning anything and you continue to buy the equity and continue to support the demand for my equity so that I can continue to issue shares, so I can continue investing in the business and actually grow the business. And I'm coming at this from the perspective of the true owners. So I'm the true owner, you're the contract holder. I need to make sure you don't really like figure out what I'm doing to you. And I need to not make sure you understand that this is a banana and you think you're getting an apple. So
something else I'd like to kind of add on here too, just
keep
as
asking.
a full disclosure, I myself am actually new to investing as well. So when I first started kind of exploring all of these things, it was really, really overwhelming to me too. So if you're feeling overwhelmed, like don't fret, because I felt the exact same way when I was first taking a look at these things. Basically, case in point, if you get anything out of this video, basically, try to remember to keep an open mind with these sorts of things, because that's really, at least, my short tenure with investing, that's really the most important lesson I've gotten, is that I need to make sure that I have an open mind. And then also that I can defend a potential investment I made as to the reasons why I made that investment. And that comes from understanding the business. So basically what we're trying to do is we're trying to have you guys understand exactly what you're buying into, which is basically a contract. So
and
yeah,
Austin,
that's yes.
I have a question for you. So, I mean, I kind of remember when I first explained this to you, you had different reasons for not investing in Chinese companies, but Express, did you fully grasp it the first time, or was it after a couple of times?
No, it was after about the 15th time, I'd probably say, you and I talked about this, that I actually started to like conceptualize and understand what it was that these entities were.
Austin has an accounting background, so it's not like he's, like, oh, I don't know anything about finance or accounting laws or anything like that. No. He had the background, and it still took, a bit of explaining. So
multiple times, like months, until I was able to like actually,
that's
like,
why
at least,
I say,
and then even now, there's still so many aspects to it that I don't fully grasp yet, which is exactly why we make these videos. And that's exactly why I try to ask you